Thanks for joining us for the Executive Series. Today I'm talking to Richard Murphy, who is the CEO of the Australian Corporate Bond Company. Richard, great to talk to you again.
Thanks, Tom.
Interesting times as far as rates are concerned, but a challenge for investors is getting access to yield, but then trying to manage the risk side of things. And you've got some possibilities as far as this question is concerned.
Yeah, look, I guess at the moment people are thinking about what's happened in the US, what happened with Brexit, what's going to happen to interest rates globally in Australia, in the US. What does a president-elect that says I'm going to spend a lot on the military, I'm going to spend a lot on infrastructure, will that cause inflation, which is kind of the concern? Yeah. And that causes very long-term bond yields to rise, which means the prices are falling. And are people saying, is that the end of a 20 or 30-year bond market rally where prices are rising? And that, of course, remains to be seen. But at the moment, the market thinks that the longer-term end of the bond market, prices are going to fall, yields are going to rise. But at the shorter-term end, sort of 3-year bonds, that's 10, 20, 30-year bonds. 3-year bonds, you're getting less of an impact. And XTBs that we have on the ASX, they're more 3 years, so they're less of an impact. Whereas the long-term end, there's a lot more volatility. So it really depends. You've got to split that market up into the long-term end and what the market thinks about inflation and rate rises in the US. The Fed, will they raise rates? Finally, they did it once. Will they do it again in December? 95% chance. Will they do it throughout 2017? Because the administration is starting to spend, which causes inflation to go up to try and build the economy. And will there be economic growth and rates generally rise at that point to then put a cap on inflation? Whereas in Australia, where are we? Are we at the bottom of the rate cycle? Will we go down again? 6 months ago, everybody thought there would be another cut. Now, that's probably 90% saying no, there won't be another cut, but it's going to be pretty flat for about another year.
Indeed. So when you must get asked this quite a bit, XTBs, are they regarded as an alternative to traditional term deposits?
They are as an alternative. They're not obviously a bank account. So if you look at a spectrum of riskier products versus safer products, at the safer end there are term deposits and bonds. At the riskier end you get equities and hybrids and things that are more volatile. So TDs would be, say, this risk, and corporate bonds would be this risk. So you get a bit more risk, but you also then obviously get a bit more return. So if we look at it in terms of what are TDs yielding at the moment, depends if it's a 1 month or a 5 year. Yep. But most of the money's at the sort of 3 month and 6 month end of the spectrum. So if you look at TDs that are published on bank websites, you get 2% and 2.4%, 2.5%. But sometimes you can get, if you get a special rate or you're an advisor, you might get, let's say you get 2.8%. So to compare that to our high yield model portfolio, that's 4.1% today. So that's 1.3% higher. That's about a 40% uplift in yield. So you say, well, am I happy with the risk of lending Woolworths and BHP, etc., money instead of lending it to the bank and putting in a term deposit? And do I want that 40% uplift for that extra risk? And it really comes down then to, well, do I think they're going to pay me back, those big corporates? And if you're willing to accept that risk, which is not zero, but it is very low because they're investment grade companies, then that is a good alternative to getting 2.5%, getting up to the low 4s is a good pickup in yield.
Indeed. So now you've got around 50 possibilities in terms of choosing XTBs. If you're something of a novice around navigating this subject, where's the best place to start?
Yeah, absolutely. So when you have one, there's only one to choose from. When you get to 20 and then 40 and then 50 as we are now, then advisors and end investors are asking us to look, and you kind of start grouping those into buckets so I can actually see which one I want. So we started themes for the advisors and they've got some choices. For the end investor, we actually copied a theme that CommSec came up with, which was starter packs for equity. So share starter packs, we just thought that was a great idea. So we now have starter packs for XTBs. Yep. So we've got the high yield one I mentioned, that's yielding about 4.1%. We have a cash plus, which is really just floating rate bonds, which are all the most boring securities in Australia. They issued 100.
Boring or low risk?
Low risk, but they never move. They just sit at around $100. So boring in that sense of when you want boring, when you need boring, it's good.
Good boring.
Good boring. So that's an alternative even to cash management. accounts. And then the third portfolio, a lot of people like brands. They like the fact that Woolworths is a brand, BHP is a brand, Qantas is a brand. So we put a group of XTBs together for those people that think, well, good brands are good companies, and so that's a separate. So there's 3 of those available on XTBs, and people are starting to take those up. And they're only about 5 each, so it kind of makes it easy to say, well, out of the 50, if you want higher yield, go for these 5. If you want really, really super stable, 0.2% volatility annually for the last 20 years, or if you want brands that you know and trust, there's 3 buckets you can actually go to and have a look at those starter packs.
Indeed. So it's, as far as the outlook for Australian interest rates is concerned, it's important to distinguish that we're not in that same environment as the United States at the moment.
No, we're not. We've obviously been cutting rates here, and rather than sitting at very, very low rates already. So the US was very, very close to 0, and then they moved up once, and now finally it looks like they may be in a rate rise cycle. We're still at we were cutting. It's still a big question mark whether we will do anything in 2017 in Australia. It's obviously up to the RBA and the conditions at the time. But if you look at that period, our view would be that we'll probably just get absolutely nothing in 2017. There won't be enough reason to cut. There certainly won't be a reason to raise. We think if there is going to be a movement, it would be one more cut. We don't think there's going to be an increase in rates here in Australia, because what the US does in terms of their policy and their economy, you know, if they start spending on the military, they start spending in infrastructure, it's going to have a very localized effect there. And of course, overall, longer term, you may get an impact, but we're not going to feel that in 2017 in Australia. We'll be driven by what's going on in our market. And I think the consensus would be that, yes, we're probably not lower for longer as people were a year ago, where it was maybe 3 years of absolutely nothing. But I think people are saying, look, 2017, there's not going to be an awful lot of action in interest rates. So people then, therefore, are still looking for yield. They're saying, well, okay, I know what I can get from shares and CommSec shares. I can go buy shares through CommSec, and that's going to be, you know, hopefully rising share prices and good dividends. But of course, it's volatile, not just the share price, but will dividends be sustained if there's the economic growth to sustain the dividend level? And that's worrying if you're an older investor. And as you get older and older and older, you really need to be thinking about, well, if I'm 20, I've got 60 years of work ahead of me. Probably 20-year-olds these days will be working when they're 80. But if you're 50 or you're 70 or 80, you need to be thinking about, well, I need to be getting more and more conservative with where I'm investing my money as I move through life. And there's an old rule of thumb. A guy called John Bogle, who was the founder of Vanguard, came up with this rule of thumb. Basically, it's not very mathematical, but he basically said you should own your age in bonds. So if you're 20, that's 20%. If you're 70, that should be 70%, because you can't really be risking your nest egg, your life savings when you're 70 by punting on equities. You should be saying, well, yes, I will have some money in equities for dividends and some capital growth, but increasingly I'm going to have an increasing level in fixed income securities where capital stability is what you're going to get. You will get known income. You'll know, okay, I'm putting my money in here, I'm going to get paid back here, I'm going to get this income along the way. That is pretty safe as long as those companies or governments are safe and they're going to pay me back. So it's similar to term deposits. You put your money in a bank, you expect to get it back, but a little bit more risk for a little bit more return. So I think that's very important that people think about, well, where am I in my life? Am I still as gung-ho as I was when I was 20 and I'm going to buy all these different equities, these high-risk equities, or do I need to start moving through life and kind of moving more and more into fixed income?
Richard, great insights. Thanks for your time.
Thanks, Tom.
Thanks for joining us for the Executive Series.